Real estate investment practice problem using OneNote. Adjustable rate mortgage or ARM with no caps. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab, down in the 5100 Adjustable Rate Mortgage ARM No Caps tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're moving from the fixed rate to the adjustable rates, the ARMs at this point in time. As we think about them, we want to always be comparing and contrasting to kind of like the standard. So we think of the standard, which would generally be the 30-year fixed rate. Think about the amortization table with relation to it, and then think about the adjustments with more kind of exotic or new or what they call innovative, which are often more risky types of scenarios, including the adjustable rates. We will start off with an adjustable rate that doesn't have any caps, and then we'll add some caps to it. Let's first do our comparison. We're first looking at the fixed rate just so we can see what the amortization table looks like. So and then we'll compare that to the ARM. We have the home 100,000. We're not going to put anything down because we're really just focused in on the loan. So we're just imagining loan 100,000, 30 years. That's 360 months, 30 times 12. The rate, we're going to start at the 10%. Remember, the rates could be different depending on where you are in the economy at a certain point in time, but we're just going to use 10% here on the rate. If we were to calculate our amortization table, then we'd have the loan up top. The payments would be fixed at the 878 about for the entire time frame, which we calculated using the payment function, which if we add pennies is 877.57. And then the interest would be calculated using that 10% rate. And we would have a fully amortized loan, which would amortize over the life and be nice, easy for an amortization table. I know these are not quite so easy, but we've done a lot of them, and this would be the straightforward amortization table over the 30 years, getting us to zero. Finally, at the end, having the same amount of the payments as we go. We have the breakout differences between the interest and principal as we go. Now, let's put the twist in place. Let's go to the ARM. So we have the adjustable rate at this point in time. So we're going to be looking first at what that rate will be. So we've got the loan, 100,000, still 30-year, 360 periods. The initial rate, we're going to start at the 8%. Remember, when you're looking at these ARMs, they'll typically be tied to an index of some kind. The index kind of being a reflection of the market, that generally being like a baseline rate on which you can base our rate, which will typically be some multiple or some increase of the index. However, the first rate on the ARM type loans will often, of course, not be tied to the index and might actually be lower in some cases because they might have a, quote, teaser type of rate, end quote, which would be the rate lower up front, which, of course, they expect to increase over time. The bank then making their money back when they get the interest for the higher rates that are expected to happen later on in the loan. So you can expect then the primary rate, the front rate, to be lower possibly if they're trying to market the loans, because then the payments will be lower up front and then they would expect the payments to go up. Clearly the bank should be concerned. You would think they would be concerned as well if the person can pay the payments later on. However, because of the weirdness of the markets these days, the bank might be expecting to sell the loan on the secondary market and so on and so forth. So they may not be as concerned as they otherwise would be. And so you've got to be, cautious of these and take this into consideration, seeing if you can pick up the loans and deal with the extent of the loan or the increases that could happen over time. So we've got the initial rate at the 8%. The margin's going to be 2%. So whatever the index is, we're going to be saying that the rate is going to be 2% higher than the index. The index is basically going to be gauging what's going on in the market. We are basing then our rate off of the index, increasing it by 2%. We're not going to be applying any payment caps or any rate caps at this point. So that's going to be it. So if we go down to our table down below, we're going to have our columns, the year, the index, the rate, the payment, the balance, and then we'll take a look at the cash flow as well. We'll also make a nice little chart about this, and then we'll do our amortization tables eventually based on it. So we can kind of group everything together when we got these more complex types of loans into a table and attempt to calculate the rate and the balance as we go. It's always useful, however, to compare it to an amortization table. I highly recommend working the problem like this in Excel, which we do. Now the index, we're going to say this is the index numbers. Where did we get these numbers? In practice, you'd have to get these numbers from the index. When we're starting out the loan, if we're starting the loan from scratch, we don't know what's going to happen in the future because all we can do is project what's going to happen in the future, the index being a reflection of what's going on in the market typically. So if inflation goes up and so on, interest rates go up and so on, then the index would go up. The index could, of course, go down as well. If it went up, it would typically be bad for us. If it went down, it would typically be good for us. So we might want to then run different scenarios. So when we're thinking about the index and we're taking out the loan, then we can make projections into the futures. And we probably want to do a best case scenario, a worst case scenario. We might try to do multiple different scenarios and see if we can do some percentage type of analysis to think about, what the average scenario would be to kind of mitigate our risk, to think about what the risk will be. And obviously, when you have an adjustable rate mortgage, more of the risk of the rate fluctuation is going on the borrower. And then if you were to increase on the caps in terms of a rate cap or payment cap, then you're mitigating some of that risk to the borrower as well. So we can think about these two ways. I can think about it up front, this index numbers up front, we're projecting them out to think about what will happen in the index, or we can think about them after 5 years have passed and what has happened with regards to the index. I like to think about them up front as if we're making the decision, projecting out what we think is going to happen into the index, and then basing our projections on that to figure out what's going to happen on our rates and our payments. And again, we might want to set this up in Excel in such a way that we can then tie to the data set so that we can make different projections about the index and come up with different outcomes and then make our analysis and judgments from there. The initial rate's going to be the 8%. It's not going to be based on any index because, again, that might be the teaser rate, the starting point rate, so it might not be tied to any index. The second one, the index was at 10%. Our margin is 2%. So it's a nice, easy calculation. We just increase it by 2. It will be at 12%. The index, we're going to say, then went up to 13% in year 3. That's what we're projecting to happen. And that would mean that our rate would go up to 15. And then we're going to say that the index is projected to go up to 15, which would mean our rate would go up to 17. And then we're projecting it goes back down to 10%, which means plus 2 would get us to 12%. So if we were going to map out the index, which again, we don't really know, we're going to have to, it's going to gauge the market and our rate, it would look something like this on a graph, right? We'd have the index doing whatever the index does, and we're going to be at basically kind of parallel to it at a 2% margin up above it. So the index could do anything. Remember, the index could go down. It could do something beneficial. It could do something non-beneficial. Our goal is to basically mitigate the risk, calculate what we believe the risk will be, and then take action and make our decision-making process based on it. So then we can do our payment calculations once we have the index, and we'll focus more on these down below. But just note that you can do the payment calculations using a payment function, and we'll take a look at that shortly, based on the rate and the prior balance, which I'm going to put up here. The loan balance is going to be the $100,000. When we do this in Excel, if we do this properly, we can copy the payment calculation down, but note that the payment's going to be staggered or dependent on the prior balance. So once we copy it down, it will not populate properly until we calculate the balance on each and every step. And there's 2 ways we can calculate the balance. For example, one is that once I have this payment for the first year, and we're going to keep on updating or checking in the form of this adjustable rate mortgage, the rate change on a yearly basis. That's how we're saying it's set up. It could be set up differently, right? You could try to set, the loan can be set up however the loan wants to be set up, but we're going to be saying that we're going to be checking the rate change yearly here, which is somewhat standard. So then we could also go to the amortization table and then see what would happen. with this payment amount and that rate after 1 year. What will our balance be? Or we could do a calculation to figure out this ending balance given this payment amount. So we do that both ways in Excel, and we'll do a little bit of an example of it down below. Once you do a payment calculation, if you use a payment calculation here, you can copy that down. But again, it'll be kind of dependent. So these two formats will be dependent. Then you do the second payment based on this number, and then you can figure out your balance based on the amortization table or copy down the formula or with a formula. Next payment can be calculated for year 3. Then you can calculate the ending balance on the table, either with the amortization table or with a formula. And then we calculate the next payment based on the 17, and so on and so forth. Once we have this information in our nice little table here, we can also think about a cash flow scenario. What would the cash flow be? I'll get into this in a little bit more detail, but it does allow us to later, but it does allow us to do an IRR calculation to kind of get an average rate in essence, or the rate at which this series of payments would be 0 on a nice quick little table here, which would be similar to kind of thinking about the average rate of the loans, given the fact that we have these differences that are happening. Okay, so we've got this nice little graph that gives us that idea. Let's think about this in a little bit more depth now. Let's focus then on just the payment amount. So if I have the index and we figured out the rate based on the index, then we can go through and do our payment calculations based on that. The first one is pretty straightforward. We would just say that we've seen these in the past with the fixed mortgages, although we're going to do a little bit of a twist on the number area. So I would say negative PMT to figure out the payment. What would the payment be? It would be the rate. The rate would be this 8%. We're going to divide that by 12 because we want the monthly rate, and that would be a yearly rate. And then we're going to say, comma, the number of periods we're going to calculate a little bit differently. We're going to put brackets, and I'm going to take it in years first. I'd like to figure out the years first and then multiply it times 12. That allows us to copy it down a little bit more easily if we were to do this in Excel. So we pick up the years, which are 30 years up here. We make it absolute because that is not in our table. It's in our data set. Therefore, $ before the L and the 5 in this case, minus N3. That N3 is referencing this 1 right here. It's referencing that 1, so when I copy it down, that 1 will always be there. And then plus 1, which is hard-coded or typed in there. So why would I do that? 30 minus 1 plus 1, isn't that just 30 still? Yes, it is. And that's what we want, 30, but we want it in such a way that when I copy this down, it'll take 30 minus 2 plus 1, which will be 29, which will be the proper calculation if I copy it down. So that's the logic as to why we're setting it up that way. Close up the brackets, we multiply it times 12, because now we looked at the years and we need the months. So we multiply it times 12, then comma, the present value. Then the present value is going to be the loan amount, which you can't see right here, but it would be the prior balance of the 100,000 in that case. And then, so that's going to be the first one. If I copied that cell down, then on the second one, it would look like this negative payment calculation, the rate. But now the rate is now this 12% because it's going up from 8 to 12. And then I'm going to divide that by 12, then comma. Then we got the brackets. L5 has now been copied down with the same number. That's referring to this 30 up top that's outside the table. That's why it's absolute. Minus, now this moved down from N3 to N4. That moved this from 1 to 2. So now it's minus 2 plus 1. 30 minus 2 plus 1 is 29. 29 years, which is what we want, closing the brackets. But now we want it in months. So we take that 29 years and multiply it times 12 to get the months. And then comma. And we would need the prior balance to pick that up. And we talked about how we would get that as we go. The prior balance being now this 99,165 would calculate the next payment. So then we can copy that formula down, remembering that these populated formulas would only populate once we calculate the ending balance as well, because they're kind of staggered in that staggered format. Now the ending balance calculation, you could do the ending balance a couple different ways. You can pick it up from the amortization table as you go, or if you want to do it kind of quickly, you can do it in the table here. I still recommend making amortization tables because they're a really good check that you're doing things, kind of correctly as you go. They give you a little bit more confidence that things are going properly as you continue on. So we're going to do our payment calculation. There might be a couple different ways you could do this. We're going to do it this way here. We're going to use this is going to be for this 99,160. We're going to say Q3, that's going to take this prior cell, the payment amount, and then divide that by, and then we're going to make our payment calculation brackets, the rate would be that 8%. Then we're going to take that divided by 12 to get the monthly amount, comma, number of periods. The number of periods are picking up the periods up top. That's going to be outside of our data set. That's that 30. We made it absolute because it's outside of the data set. And then minus 1 being that 1 right here. That 1's going to copy down all the time. So it's the 30, the years, minus this year that we're currently in. So we're at 29 years, multiplied times 12 to get the number of months. And then comma, instead on the payment side, on the present value, instead of taking the loan balance, we're going to take 1. So we're kind of backing in to the loan balance with this formula. That would give us then the 99,165. If we copy that down, then the next one would be equal to Q4. Copying it down, that would be this cell. And then we're going to divide that by negative PMT. And the rate is going to be then the 12% divided by 12, comma, number of periods is L5. Notice that's the same as the prior cell. That's the 30 down here in years minus N4, which has changed. That moved down from 1 to 2. So that'd be 30 minus 2 or 28. And then close up the brackets times 12 to go from years to months. And then comma, and then we just have a 1 here as at the present value, that giving us the 98,758. Now, if we copy that down, then again, this will calculate it without needing to go to the amortization table, although note that we do have that staggering issue that it's going to be dependent on the payment in order to calculate the ending balance. So we can then check this out in terms of the amortization table. What's going to happen if I was to try to amortize this? So if I scroll down, this is what our amortization table looks like. We'd have to change basically the payments. So now the first payment is based on that 733, and the rate is calculated based on that 8%. So in other words, if I was to calculate the rate as we go, 100,000 times 0.08 divided by 12, that's where we're getting the 666.66 number here. And then we got that going down, and then it changes to the next one 1 year out. That's the 1,023.73, which is about 1,024. And now the rate changed to 12%. So in other words, if I take this prior balance 99,165 times 0.12 divided by 12, we get about the 992. And then it changes for the year 3 to this amount, 1,254. And then we had to change the interest rate. So you can see how this is kind of impacted on the way down. Now notice if we change all of these after year 5, that's where we stopped. So we just copied that change all the way down. And then if we do this properly with the amortization table, we can kind of double check with this kind of loan that the amortization table will still fully amortize or go to 0, in other words, after the 30 years, which is kind of nice. And you can do that basically as you go. So let's take a look at that in a bit more detail. And let's make an amortization table just changing one thing at a time. So in other words, if I was in year 1 and year 2 had not yet happened, then I can say, okay, that means in year 1, we'd have this 734. And then let's say year 2 just happened and year 3 has not yet happened. I'd have the 734. Then it goes to the 1024. So there's the 1024, the rate at the 12%. I would copy that all the way down. So as if that's going to happen for the next 30 years, because I don't know what's going to happen after that point. So we're after year 2, and we made this change from year 1 to year 2, changing the payment amount, changing the interest amount, copying that change all the way down. And we can kind of double check our table then and say, what does that do? That makes us go back to 0 at the bottom down here, giving us some indication that it's been done properly. If we go then to year 3, then I can say, let's say we're stopping after year 3. This is as far as we've gotten, 15%, 1,253. So now we got the payments here, here, and now we're at the 1,253, 15%. So if I take, for example, the prior loan balance, 98758 times 0.15 divided by 12, we get about 1234. And then we've got the difference here. If we copy that all the way down, because we don't know what's happening in year 4 yet, and look at the amortization table, we can kind of double check that we're doing this properly, because it should once again fully amortize, given the fact that we're changing both the rate and the payment. If we did that to year 4, so now we're in year 4, 17%, 1410. So now in year 1, it was 7, 1024, 125. And then in year 4, we're at the 1410, and the rate was 17%. So if I took this prior balance here, which is the 98510 times 0.17 divided by 12, we get the 1396 about. And if we didn't know what happened in year 5 and we copied that all the way down, these payments all the way down, and the new interest calculation, again, this whole thing should work out, even though it's getting kind of funny looking, but it still fully amortizes. So that's kind of nice. And then in year 5, we're going to say it goes back down to 12%, and the payment 1029, and that's all we know at this point, even though it's a 30-year loan. So we're going to say, all right, let's go down to year 5. Now we're at the 1029. We went down to 12%. So in other words, if I took this 98318 times 0.12 divided by 12, we get the interest of the 983. And once again, if I copy that all the way down, because we're only have 5 years out, it should be fully amortized at this point. So we don't know what's going to happen from year to year, but we can at least plug into the amortization table kind of as we go and give us some verification that we're doing things properly, given the fact that the amortization table is fully amortized at the end of the process. Now, if we go back to our data set here, so we've got this nice little data set that's giving us the payments and the balance. The balance here, notice that we can double check the balance as we go, so we can look at that 99,165, the 98,758, the 98,510. So let's just check that real quick. The other way we can look at these ending balance, we can pick the 99,616 after year 1, 98,758 after year 2, 98,510 after year 3, 98,318 after year 4, and 97,732 after year 5. So we could have pulled those ending balances then from the amortization table, or calculate them with a formula and then double check them to the amortization table. And then we can get a nice quick kind of cash flow with this little calculation method we have used here, saying we start off with the 100,000 representing money that we can imagine we got from the lender, and then we took that money and paid it to the seller to buy the home. And then we can imagine the outflows, which would simply be the payments, and there'd be 12 of them per year. So I could take the outflows, in this case, year 1, 733.76 times 12. That would give us 8,805. Year 2, we got the payments of 1023.73 times 12 would give us the 12,285, and so on. And then we can look at the internal rate of return, the rate at which this series of payments would be 0. And that should give us an idea, taking into time consideration of money, of the cost of the loan, based on if we were using a projection, for example, this estimate of what's going to happen with the index and what's going to happen with the rate. And then oftentimes we would take that internal rate of return and possibly, use that as a gauge as to whether it would be a good investment versus other investments, possibly. That would be one idea of using that. So we can pull that in, and we would get the 12.43. So that's kind of like the average interest rate you can kind of think about. So in other words, if you calculated like the average rate, you could try to do that, but it's not quite as accurate as an IRR, which is the rate at which the series of payments would be 0. But you can think of it kind of like, well, if I took the 8% plus the 12% plus 15% plus 17 plus 12 and divided by 5, I get a 12.8. So again, that's not as accurate generally as an internal rate of return, taking into consideration the time value money, the rate at which this series of cash flows would be 0. but it's kind of the same idea. And then note that this one is not completely accurate, however, also because we estimate it on a yearly basis instead of on a monthly basis. So this 8,805, for example, using this calculation method assumes that the payment happened at the end of the year, when in actuality we know it happened in 12 equal points throughout the year, 12 months within the year. So that means this 12.43 is not as accurate as if we calculated this on a monthly basis. So we could then calculate it on a monthly basis, and just let's look at our tools there. Remember, as we do this, if you were to project out using this method, what you'd want to be doing is basically running different scenarios, because we don't know what's going to happen with the index. So you'd basically be saying, okay, what's the worst case scenario? Would I be okay? And the worst case scenario would be the best case scenario. And then what's the likely scenario? Is there some kind of rate or percentage that I can kind of estimate what the likely scenario would be, and then base my decisions on that kind of analysis. And then also, of course, you can compare this loan structure to other loan structures, possibly structures of loans that are ARMs with caps on them, or possibly to standard kind of loan structures, and so on and so forth. Also, you might have the loan or be expecting to have the loan, say, for 5 years, and then you're going to sell the home or something like that, or 3 years or something like that. So the time frame is another thing that could vary over time. Now, just remember, obviously, most of these kind of loans, when people go into them, the expectation is that the home value is going to go up basically forever, right? And that most likely, hopefully, is the case, that the home values go up. And then if there's any problem, at least you got the equity in the home and so on. But we know that home values, property values can go down. I mean, it has happened. So the worst case scenario would be that property value goes down, and now it's possibly even less to than or equal to the loan, and then the rate on the payments go up, which kind of could lock people in if they were actually trying to sell the home at a shorter period of time. So that's when people when things get locked up, right? Could get locked up that way. Okay. So in any case, if we then go down here, we say our ARM, let's figure our ARM for the whole life of the loan, even though we only have 5 years of payment information. It looks something like this. We'd have our payments, our payments per month now. The $100,000 is what we received in order to buy the home from the loan. And then our outflows were $734. They went up to $1,024. They went up to $1,410. Then they went to $1,029, and that's what they were for the rest of the loan, because we only have 5 years out worth of data. If we assume it's at that $1,029 for the rest of the time flow, and we calculate that up, it would have a cash flow of the $273,183, and the IRR, the rate at which that entire cash flow would be zero, would be the 12.29219, which again you could use to compare to other kind of investments. And how close is that to our 12.43 here? If you assumed the same thing, but you assume that you're going to have it or sell in 3 years, you can kind of stop off the cash flow on a monthly basis to 36 payments, which would be 3 times 12. And that would be the cash flow of the 34,645. The IRR, the rate at which this series of payments would be zero, would be at 11.39 at that point. So obviously, when you stop the loan, you're going to have an impact on this cash flow. Also note that last amount, the 99,763, if I go up to 36 time frames here, 36 time frames here, after 3 years would be right there. You'd have a loan balance you'd have to pay off. That would be an outflow if you sold the property, 98,510. And then you'd also have to pay that last balance, 1,254, assuming we're paying this at the end. And that's where we're getting that 99,764 about at the end. And then if you did it for 5 years, then it would look something like this. We got the 100,000, bringing this on down to 60 payments, which would be 5 times 12. Here's our cash flow. The IRR rate at which this series of payments would be 12.44, noting that at period 60, the last month, that 98,761, same concept. We'd have to take the ending loan balance that we would have to pay off at that point, plus the last payment that we would make. That 12.44 is a little bit more accurate than the 12.43, which is pretty close, that we got when we estimated on a yearly basis. And then we can also, if we took it on a yearly basis, it would be this information, right? Same kind of calculation on a yearly basis. You can pull this information on a yearly basis if you make a pivot table quite easily as well. So we'll do that in Excel if you want to practice that. We've seen that in prior presentations, so I won't go into it in detail here. But if you're comparing different scenarios like this, the little table we made up top gives us a lot of good information on a year-by-year basis, but it doesn't give us, we could add it on the pivot table, say, for example, the interest per year. And if you add the interest per year, then that might help you with tax kind of calculations and deductibility of possibly interest as well. So adding the pivot table would look something like this, adding the years, and then the payments, the interest, the loan, and then you got this year-by-year breakout. Similar to the table that we built, we still got the payments, but then we have the interest here, which is something that wasn't on the table that we put before. So again, that could be a good tool to use the pivot table to be able to refresh it with different scenarios as well, possibly taking into consideration tax implications and so on.